The money supply in America just contracted again, a huge deflationary depression warning. This is the first time the money supply has contracted since the Great Depression. The 3 other times the money supply contracted in US history, we had huge unemployment and a massive banking crisis. And if banking crisis sounds familiar to you, it should, because right now in America, we're seeing some of the biggest banks go under. 2 months ago, it was Silicon Valley Bank. Now it's First Republic. And make no mistake, if the money supply keeps contracting in America, if the Federal Reserve keeps aggressively sucking money out of the system, more banks will fail and the chances of a massive depression with a double-digit unemployment rate go up significantly. And really, folks, it's all related to a simple economics 101 formula. MV equals PQ. That is money supply times the velocity of money equals the price of goods in the economy times the quantity of goods in the economy, also known as GDP. And you can understand this historical relationship between money supply and GDP on this graph. The red line is the year-over-year change in money supply. The green line is the year-over-year percentage change in GDP. What do you notice? Going back to 1960, the growth rates in both of them track each other almost identically. MV equals PQ. Then you notice the big explosion in money supply that occurred during the pandemic when we printed all that money, and now we're contracting on the money supply, and GDP growth has only started to decelerate. But what you can be confident in is that so long as this money supply stays negative, the GDP line will follow it. The inner plumbings of the financial and banking system are crumbling before our eyes. So think about it, folks. We have this triangle going on right now of money supply contraction over here, big bank failures over here. Silicon Valley Bank and First Republic were the 14th and 16th largest banks in America, to go along with now a credit crisis where banks are saying they're not going to lend any more money. And ultimately, it's bank lending and credit which sustains an economy. You need banks to lend money for the economy to grow. If businesses can't borrow, and if businesses can't refinance their debt, they're going to shut down and lay off workers. And ultimately, folks, this can become a vicious circle, because if banks cut back on lending, that's going to cause the money supply to go down by more, lead to lower deposits and more bank runs at banks, which is going to cause more banks to fail. And then they're going to cut back on lending more, and then the money supply is going to go down by more. And that's how you get a depression. And these banks are likely to continue to lose deposits, because now we are seeing companies like Apple provide a savings account that offers 4.2% interest per year, while many of these regional banks are still offering only like 1.5% or 2% interest. So what's going to happen? People who are banking with regional banks are going to move their deposits to Apple, which is not going to actually have a net impact on deposits in America, but it's going to have a huge impact on credit into the system, because the regional banks are the ones that make loans, while Apple doesn't make loans, they make phones. And so fewer deposits with the banks and entities that make loans into the economy is going to mean loans are going to contract, and the money supply is going to go down by more, and all the issues I'm talking about in this video are going to become more exacerbated. And what's really scaring me is that no one is paying any attention to this. The massive warning signs of a depression that we haven't seen in nearly 100 years are in our face, and the Fed's not talking about it. The mainstream financial news isn't talking about it. And in fact, folks, the Fed is like actively making this situation worse through their monetary policy right now. Not only are they hiking interest rates, but they are doing quantitative tightening. Quantitative tightening that's destroying money. You can see that destruction through looking at the Fed's balance sheet. The assets on the Fed's balance sheet are going down. They increased a little bit when Silicon Valley Bank failed, but now they're going down again. And the way that this works, everyone, just so you understand it, is that during the pandemic, the Fed printed money by basically buying bonds and mortgage-backed securities. US government issued debt, or a bank made a mortgage, and the Fed just bought it with printed cash, and that's how the Fed increased the money supply during the pandemic. But what they're doing now is that when those bonds and mortgage-backed securities mature and the US government or the bank that made the mortgage has to pay back the Fed isn't putting that money back into the system. They're just letting the money disappear, which is how we get this somewhat esoteric concept of money supply contraction. And to be clear, everyone, on Main Street, in your real life right now, it's going to be hard maybe to see some of these realities. Like if you go to a restaurant to eat out, or if you go to rent an apartment or buy a house, things still look very expensive. They are very expensive. And it might not feel to you like the money supply is going down and there's deflationary forces in the economy present. However, understand there's a lag from monetary policy actions to inflation and their effects on the economy. According to Milton Friedman, the godfather of monetary economics, as well as further research, it takes over a year before monetary policy actions have their peak effect on inflation in the economy. And so what that means is that money supply contraction today and over the last 3 to 6 months is going to mean lower inflation and potentially deflation in America in the second half of 2023 and the beginning of 2024. And in case you're skeptical of the fact that inflation is going to turn into deflation and the money supply matters, let me show you some historical data that really hammers this home. On this graph, the orange line is the change in money supply over the last 150 years, while the blue line is the change in inflation. And again, folks, what do you notice? They're extremely correlated, and typically it's the money supply, the orange line, which grows first. During World War II, 1943, M2 grew by 18%. We had to finance the war and print money. It was 2 to 3 years later where inflation peaked. How about in the 1970s, folks? You guys remember the decade of inflation we had in the 70s. Well, why do we have that inflation? The money supply in 1971 grew by 13%. That happened good 2 to 3 years actually before inflation peaked. Additionally, there was another peak in money supply in 1976. Inflation peaked again 3 years later. Today, we're in the situation where the money supply growth peaked in 2020 and is now gone negative, indicating that this inflation will continue to decelerate and potentially go negative into deflation. And the prospect of deflation sounds good on the surface because it's going to mean lower prices of goods, it's going to mean lower rent, it's going to mean lower home prices. Deflation is bad for the housing market, just so everyone understands that. But what goes along with deflation, especially in a heavily debt-ridden economy like ours, are big increases in unemployment and corporate bankruptcies. We're not going to get deflation without some big problem associated in the economy. And understand that this is a big warning signal for economic turbulence. Because again, only 4 other times in US history where money supply contracted, the unemployment rate was 25%, 11%, 18%, and 14%. That's a pretty ominous record and suggests that a lot of the people who aren't taking this recession seriously, who aren't taking the initial stages to this housing downturn seriously, need a reality check. Folks, you need to look into the historical data because what it says is very concerning about the future for the economy, the housing market, and stock market. Now, of course, the Fed can pivot. This isn't a guarantee that it's going to continue flowing this way. The Fed could make a decision in a month or two to cut rates and turn the money printer back on. And maybe they will turn the money printer back on eventually and reverse some of this. However, in the short term, it really seems like Jerome Powell is committed to establishing the Fed's credibility and getting inflation down to 2% year over year. And it's actually kind of scary because he's so committed and the market is buying into what he's saying so much that no one is looking at the major economic warning signals. And it's something that's pretty distressing to me, everyone, because I'm someone who's been predicting a downturn for about a year and a half in the economy, 2 years in the housing market, and we've started to see it. And at first, when I saw this data, I actually got excited. I'm like, oh, my predictions are going to turn out to be correct. However, the more that I think about what contractionary money supply means, the more I'm frightened. Because when the banking system starts to have problems, it can really start to negatively impact a lot of corners of society and life that you wouldn't expect. Folks, what would you do if you couldn't get money out of your bank or your credit cards didn't work? And I'm not saying that that's definitely going to happen, but like for certain banks, it's happened. Silicon Valley Bank went under. First Republic Bank is about to go under. According to the Fed, those were the 14th and 16th largest banks in America. Gone. And there will be more of them so long as the Fed continues to suck money out of the system and so long as banks are scared to lend money. Real quick, let's talk about the problems that First Republic has. Why is First Republic about to be taken over by the FDIC? Well, it's pretty simple, folks. According to their most recent earnings report, their loan book went up 23% year over year. First Republic pushed 23% more loans out into the economy, which is a highly inflationary thing to do. At the same time, their deposits were down 36% year over year. That right there is all you need to know about why First Republic is going under. They aggressively expanded their loans while their deposits went down. And since it's the deposits which fund the loans, First Republic has now run out of money. And they were the victim of an old-fashioned bank run where there was a panic and people pulled their money out. They had a lot of uninsured depositors and poof, they're gone, just like that. And you have to imagine, folks, that this is now scaring many banks in America, particularly the regional banks, the middle market, the semi-large regional banks, which are the ones that do most of the lending in the economy. You can bet that all of their CEOs and all of their risk officers right now are saying, hold on, let's pull back on making new loans, let's increase the underwriting standards and increase our cash balances so that doesn't happen to us. And what's another bank that could run into issues over the next couple of months? Well, this is Just speculation on my part. Take this with a grain of salt, but I think US Bank Corp could be one that has some problems because US Bank has been very aggressive in extending its loan book. 22% growth in loans, 16% growth in assets over the last year, now walking into a kind of a banking crisis and liquidity crunch in the economy. Now, they're not in huge trouble yet since their deposits have gone up 10% year over year. But if this deposit amount were to start to go down, if people were to start taking money out of US Bank Corp, they could have some similar liquidity issues to what we saw at First Republic. And to be clear, folks, that's not a solid prediction. It's just some analysis I did. I'm not predicting a bank run for a specific bank. But I think if you're someone who wants to understand the health of your bank, you should be looking at their financials. Look at how much their loan book has increased. Look how much their deposits have gone up or down. Try to spot if there's some misalignments. But again, I suspect for some of you, this is very maybe theoretical or esoteric because there's this still perception that there's all this money in the economy and all this liquidity. And I'm here to tell you folks that there really isn't. Liquidity has been shut off in the economy over the last 3 to 6 months. And any perception of there being strong liquidity is purely being driven from what occurred in 2020 and 2021 and all the money that was raised back then. And that money at some point is going to run out if it doesn't get replenished by new liquidity. And the clearest way that you can understand this is by looking at corporate Wall Street real estate investors. Those big Wall Street landlords like Blackstone and Amherst Holdings and Progress Residential and Tricon, they have barely been able to raise any money over the last 6 months. You can see on this graph, which tracks the mortgage-backed security issuances for big Wall Street landlords. They use these mortgage-backed securities to fund their home purchases. What do you notice? Big run up in mortgage-backed securities in 2020, 2021, and early 2022. They raised a lot of money to go buy homes. But then what do you notice after that? Third quarter 2022, big drop. Fourth quarter of 2022, even bigger drop. First quarter of 2023, non-existent. The Wall Street landlords only raised $900 million in the first quarter of 2023 compared to $7 billion at the end of 2021. So this is the liquidity crunch and credit crunch playing out before your eyes, everyone. And so while maybe some of these Wall Street landlords are still buying based off money they raised 2 to 3 years ago, they're going to run out of that money soon. They might even be told to stop buying and start selling if some of the banks that provide additional credit lines to them go under. First Republic Bank was a big lender into the single family and multifamily space in America. Let's check out their loan book. Of their $168 billion in loans, $100 billion of that was for residential real estate, $22 billion was for multifamily, $11 billion was for commercial real estate. And now First Republic might get taken over by the FDIC. So what does that mean for future liquidity into the real estate space? Folks, it means there's going to be less. So at this point in the video, I hope you see how all of this is adding up, folks. Liquidity crunch, banks going under, the money supply contracting, the Fed actively working to take money out of the system, all the historical data about how the money supply corresponds to inflation and GDP and depression periods. Like, this is all happening right now, and no one is paying any attention. Of course, let's analyze how I could be wrong about all of this. How could I be wrong? And how could maybe the money supply start going back up and banks get more aggressive in lending so we avoid this continued money supply contraction scenario that's going to cause deflation and a big increase in the unemployment rate? Well, one easy way I could be wrong is if the Fed just turns the money printer back on. Maybe in 2 months, they just turn it back on and they stop quantitative tightening and they rescue the day and they cause more inflationary forces into the future in the economy. And that's always a possibility. But right now, it does not seem very likely. The betting market's predicting an 86% chance the Fed hikes rates at their next meeting in May. There will be no immediate relief from the Federal Reserve. Well, what about banks? Could banks get more aggressive in lending and thus cause the money supply to start growing again? Well, anything is possible, but if you look at what the bank loan officers are saying, that's probably not going to happen. With a net 45% of loan officers saying they were tightening their lending standards at the end of 2022, and that was before Silicon Valley Bank. We're going to likely see even more tightened lending standards into the future, and you can see historically that every time we see these tightened lending standards from loan officers, there is a recession. We're not going to get immediate relief from banks, but there is a third potential outcome that could cause money supply to start going up in America and to prevent a deflationary depression, and that is de-dollarization. Other countries abandoning the dollar and pushing their excess dollars back onto US shores because they don't need them anymore for trade or to buy oil. And this is a process which has started already. For instance, the BRICS countries are considering using their own currency for trade, which could end the dollar's hegemony. And I'm ultimately a believer that this will happen at some point. I think the US dollar's reign is going to start to come to an end, but ultimately this is not going to be a fast process. The dollar is so entrenched within how banks and financial institutions do business around the world that it's going to be a very painful and long process for other countries and institutions to deleverage from the dollar. You can understand this by looking at the dollar exchange rate right now. On the DXY, we can see the dollar has lost a little ground over the last couple of months, but at around 101, it's actually still at its highest level compared to other currencies in the last 20 years or so. So the dollar is still relatively strong, historically speaking. This leads me to believe in the shorter term, over the next 2 to 3 years, this contractionary money supply, deflationary recession or depression scenario is going to play out. It's going to be bad for home prices. It's going to cause rents to go down. It's going to cause the prices of commodities to go down. And really the next warning I'm looking for to really confirm that this is happening is I'm looking at commodity prices. Because in every other monetary contraction period in US history, we saw a big collapse in commodity prices, whether it be energy or food or metals. Right now, according to the Dow Jones Commodity Index, we have seen commodity prices start to go down from their peak of about a year ago, but you can see they're still elevated. Overall commodity prices are still up about 50% from their pre-pandemic levels. And so for additional confirmation that this deflationary outcome is going to occur, we'll need to see the Dow Jones Commodity Index go down further. Hope you guys enjoyed this video. Let me know what you thought of it in the comments below, and make sure to hit that subscribe button so you don't miss this content in the future.